Today we're looking at the independence of the US Federal Reserve and whether the criminal investigation that's been opened by the US Justice Department against Federal Reserve Chairman Jerome Powell is part of a new era of monetary oversight. Now, whilst the headlines do appear to be quite dramatic, this is actually all part of a long-running battle about the independence of the Federal Reserve and whether the government should have a more active role in setting interest rate policy. But first, let's look at the Federal Reserve, its origin and its purpose. Founded in 1913, it's basically the central banking system of the United States. Its creation followed a series of financial panics, which exposed the need for a centralized institution to stabilize the banking system. The purpose of the Federal Reserve is roughly threefold: maximizing employment, stabilizing prices, and managing long-term interest rates. Collectively, these are known as managing the dual mandate of employment and price stability. The Fed manages monetary policy by adjusting interest rates, and it also regulates banks to ensure financial system stability, acting also as the lender of last resort during crises. The Fed's role really expanded significantly during the Great Depression and then during World War II. Now, for the 20 years plus that straddled either side of the millennium, adjustments in interest rates were the main policy tool in a period that was called the Great Moderation, where low and steady inflation supported a period of growth. The Federal Reserve was generally left to its own devices during that time. But since the 2008 financial crisis, with rates regularly close to zero, the Fed has employed additional measures such as bond buying, often called quantitative easing. And the reliance on debt and leverage in our highly financialized economy has meant that classical monetary policy alone cannot necessarily cope. Today, the US government believes that anemic economic growth is crying out for lower interest rates, whilst the Federal Reserve is nervous that cutting rates could stimulate a rebound in that recent inflation. Now, both arguments are valid, but obviously this is becoming an increasingly political battleground. Powell was set to stand down in May anyway. But for markets, the main concern is that without the balance of a neutral Fed, unchecked quantities of liquidity could undermine both the bond market and the US dollar. Now, higher yields, however, would not be acceptable, and this would probably lead to bond buying that targets a specific level of yield, which is often called yield curve control. But this would still undermine the US dollar. Therefore, any move against the independence of the Federal Reserve is likely to have negative implications for the US dollar. And this outcome would be yet another boost for precious metals such as silver and gold. Indeed, this ongoing threat has been one of the main drivers for precious metals over the last few weeks and months. And gold should continue to test the all-time highs. Okay, now let's look at some of the questions we've been getting from our viewers. First up is, will the boom in traded volumes of US equity stock options continue? Well, the last few years has seen an absolute explosion in the use of single stock equity options. So why is that, and can it continue? Well, the volume of US equity options has surged for a variety of reasons. Costs and technological barriers fell dramatically with the introduction of zero commission trading, while mobile apps have made options trading simpler and more accessible. And as a result of that, retail participation really took off, which was then boosted by stimulus money and free time during the COVID era, and then popularised by social media communities like Reddit's Wall Street Bets. Innovations such as the introduction of 0 days to expiration options enabled shorter-term leverage opportunities, whilst more underlying securities began offering options contracts, especially on popular ETFs like the Spiders and the Triple Qs. So it feels there has been a generational shift. However, it's unlikely that these factors can be replicated again. Higher volumes are probably here to stay, but we shouldn't expect the same level of volume growth unless excessive government liquidity juices the market once again. The next question is, can the breakout in copper continue? Well, copper has surged after breaking out of a wedge-shaped consolidation pattern. If the current move matches the gains from 2020 to 2022, then it could target a move through $15,000 per metric ton. And as we've discussed before, the long-term thesis is a demand-supply imbalance that requires significant amounts of copper to build out the infrastructure of the energy transition. But nothing in the mining world happens quickly. And on top of that, we have the same underlying forces that have supported the surge across the precious metals complex this year, whilst geopolitics have emphasised the ongoing race to secure critical supplies of global resources. Long-term trend-following investment mandates continue to chase this theme, and that suggests that this breakout could have more legs. And our final question is, what's the biggest threat to the surge in hard assets and commodities? Well, in simple terms, the biggest risk is inflation. You see, many of these assets are both the hedge against inflation, and they also help to define the type and speed of the inflation that we get. But eventually, that might lead to a level of inflation that forces the hand of policymakers. And that brings us full circle back to the discussion about the independence of central banks. An independent Fed might be expected to act quite quickly to contain a breakout in inflation. However, a shackled Fed, on the other hand, may be instructed to focus on bond buying to cap yields before those yields hurt the economy. And that doesn't eradicate inflation. In fact, it's recessions that have historically had the best record of stopping an inflationary surge. And obviously, if that occurred, then all risk assets could be in trouble. Okay, that's it for this week. But before I close, please remember that none of this is investment advice. It's for education and engagement purposes to help you with your own research, and when investing, understand your own risk tolerances, time horizon, and investment objectives, and then invest accordingly.